tick, the bell has gone, and mid-cap's doing better than frontliners. That's the first trend. The Nifty is actually at the flat line with a bit of a negative bias now. What's pulling it down? It's financials, actually. Look at banks straight away. Bank Nifty is lower by about 0.3%. ICICI Bank, Kotak Mahindra Bank, HDFC Bank, Axis Bank. Private sector names not working for the bulls today. And that's where the major drag is coming in from. ITC is also on the lower side of the screen. So these are the big stocks. Titan is on the lower side. Some consumer names. What's working? A couple of the PSU names. ONGC, NTPC, Power Grid, Coal India. So it seems PSUs is still a favored space in the market. And apart from that, you've got Mahindra and Mahindra that's doing well, about a 1% gain coming through. Britannia is doing well. So that's how it's cutting up. Early trends, PSUs get a green tick mark. Some of the rural-facing stocks, which at least sort of signify rural spending like M&M, they're getting a green tick mark. But financials are the watch point. The Bank Nifty is already down 0.5%.
All right, let's pull up a couple of these railway-related names. There's going to be continuity out there, and that's why, in fact, the street likes that. RVNL as well as Ircon, both of them top volume movers today. They, in fact, have opened up well in the green. Yeah, Poonawalla Finance as well. Yesterday, the stock was under some pressure because, one of the people in managerial positions did sell some stake. But today, in fact, the stock has bounced back close to around 3% in today's trading session as well. Hoodco, it continues to fly away. That's up close to around 7%. Hormuz told us about that note on HCC. That stock is up close to around 6% odd. So good up move is what we're seeing out there. What's not doing too well? Well, you have Honasa, that's down close to 5%. Couple of large trades. Interglobe Aviation is down 3%. And IRB Infra as well, down close to around 8% odd. But otherwise, a quiet-looking screen. The mid-cap index, though, that's the bright spot, up close to around 80 points.
Yeah, all the blocks have, I think, happened on NASA, on Interglobe. Lots of blocks, 1, 2, 3, 4, 5, I can count. IRB. So these are all the early blocks that our team was alerting us on.
Absolutely. And, the oil stocks, by the way, ONGC is one of the top volume-led gainers, right? Oil has seen about a 3% pop. I saw this call from, I think it was Investec. IndiGo is down. So it's basically a large part of it, of course, is what's happened overnight with oil. Big rally in oil. Producers jumping, users, of course, seeing a bit of a sell-off. And IndiGo's got that block sale as well. In any case, I mean, at least on a day-on-day basis, not a positive sort of environment. Hoodco is up 7%, so 285 on Hoodco. It's the biggest volume-led gainer. It's followed by ONGC. NBCC is up 5%. Poonawalla FinCorp recovering a little bit, as we just mentioned. We got HCC with a 6% pop, 42 rupees, big volumes. Ircon is up 4%. Reliance Power is up 5%. Sterling Wilson Solar is up 4%. 789 on that one. TRIL sold off about 7-8%. There's a QIP, as Abhishek highlighted. That's Transformers and Rectifiers. It's up 3%. It's a SME name, Oriana Power. Largely in solar installations, 7% higher. It's had a vertical one-way rally. Some prominent names there as well. Bikaji is up 4%. Bikaji at about 700 plus. There is Donier and many more names. But you go down the list. Schneider is up 5%. But volumes are lacking if you go down the list, at least right now. So Heritage Foods is seeing a bit of a pullback. It's down 3%. It's had a one-way move lately. There is a BPCL, which is down about 1.25%. Amara Raja had a large move, 2%, 2.5% lower. And there is PNC Infra, which is down 8%, 482, 481 coming through at this stage. IIFL is another one of those names which has had a move from 400 to 495. Once the audit, the RBI sort of required audit was completed, stock seeing a bit of a pullback after a big move. It's down about 1.8% or so right now. KCP is another one. KCP is down 5%, as we had highlighted. Stock's done very well from about 175 levels. It rallied to about nearly 250.
Just one more, Prashant. This HCC call that Elara has put on, what Hormuz just told us, the market's taking note of it because Elara is saying that this is a turnaround story and you need to get on it quickly. Their target is, I think, 62, if I'm not mistaken. Let me quickly revisit that target. 63 rupees is the target, as they're expecting HCC to go back to its glory days and bid for the big project. So that's 7% up on that stock.
No, absolutely. And, that's about, 43 on HCC right now. Well, Lawrence Blanco is with us of CLSA. He's, of course, one of the most sort of keenly watched technicians out there. Lawrence, great to have you. Good morning. Thanks very much. I did see what you said on the 7th of this month. This is, of course, after the results came through. and you were basically looking at the big market sort of bull phases we've had. You looked at the 2000 to 2000 and that period starting about I think 2003 onwards. Then the GFC. Then you looked at the next move all the way till 2020, the COVID fall, and then this one. And your basic thesis was that the uptrend is intact, Lawrence. So why don't you sort of contextualize for our viewers what we've seen last week with the big volatility? Has that changed anything at all? And what would markers for you be?
Yeah, I mean, so from the longer term side, the idea behind that piece was just to illustrate that longer term trend that you've seen develop off the COVID lows is still very much intact. And to put it into historic comparison, the bull phases that you had from 2001 into 2008, that was a 600% gain for Nifty. Then it was followed by the 2009 to 2019 gain, which was over 450%. So, on that longer term trajectory, end of this decade, we're talking about targets between 30 and 37,000. So that's the longer term sort of runway that we're looking for the Nifty at the end of the day. But, in the shorter term side, it's been quite a frustrating move from February, because every marginal new high that we've seen the Nifty set, it's been followed by a short, sharp sell-off. And, the election results sort of played into that. It's the biggest sort of intraday decline that we've had since the 21st of January, been just over 6%. But it's also, comparing it to the 2004 election results reaction, the 2019 reaction, this is the quickest recovery of that initial decline that you saw from 6% last week. So added volatility, but it doesn't change the longer term outlook on what we've seen for those trends in the market.
Okay, so Lawrence, hi, good morning. So outline that longer term trend once again for us, and the targets and the levels that you'd look at, since you think that this whole roller coaster doesn't change it.
That's right. I mean, we didn't violate any longer term trends being the 200-day or 200-week moving average. And we're talking about these decade-long trends that you've seen in the Nifty from that 2001 low. So, to put into perspective, end of this decade, that's where that 30,000 to 37,000 upside target is based off those trends that we see now. And then the shorter term side, 21,100 is the 200-day. And on an intraday basis, that's what we got close to on the reaction to the results last week.
Could you just repeat the Nifty target, Lawrence? I think I heard you say 30,000. These are long-term targets, right? If you could just repeat them.
Yes, so that's end of the decade, right? End of this decade.
End of the decade.
Between 30 to 37,000. Those are the targets that we're looking at.
And something a little more near-term for us. So we got that. Those are big numbers, end of the decade targets. 30,000 to 37. We're 5 years off, actually. It's not that bad. It's not that long off. But anyway, 30 to 37,000 on the index. That's end of the decade. And maybe slightly more near term?
Yeah, so, I mean, like we've said on a number of times on the interviews that we've had before, we think we're in the consolidation period here where the upside's sort of limited to this 23,700 to 23,800. So that's the shorter term upside potential. And really the level that we're sort of highlighting as where you accumulate or rebuild positions here is on volatility and corrections back towards the 21,000 area.
Hi, Lawrence. Good morning and good to see you in. I don't know, I would expect the Nifty to be at the higher end of that range, 30 to 37,000 at the end of the decade, going by the kind of momentum that you're seeing and the way the markets have been moving. But we take your point, 30 to 37,000 on that. Give us a couple of levels that we're looking at in terms of, the global cues. The dollar index, the yields as well have popped up a little bit in the last few days. And both those two, they're important for an emerging market like India.
Yep, totally. So if you look at the dollar index, pretty straightforward. After that decline of 10% that you had off the September 22 highs, dollar index very much been range bound between 99 and 100. That's basically been the bottom end of the trading range for the past 18 months. And the top end's been sitting at that 106 to 107 area. And, we're sitting around 104. So very much towards the upper end of that trading range, but we're not seeing any dynamic set up for an ultimate breakout. And if anything, if we look at the longer term profile that we have for that dollar index, this trading range, which is in a lower level than the peaks that we made in September 2022, we think is part of a downtrend developing in that dollar index, but in the near term, clearly dominated by that trading range setup. And then as far as yields go, we did see quite a big reversal on Friday. For the 10-year yield in the US, we're basically looking at a trading range between 4.33 being the bottom end and 4.70 being the top end of that trading range.
Lauren, just clarifying one more point. When you were talking about more sort of near-term Nifty targets, you said 23,800 is the level that you're watching out for. And that's over what sort of a time span?
Well, that's a short-term time horizon. So we're looking at that over the next month.
Next month or so. Okay.
Yep.
Lawrence, let's talk, maybe sectors if you can, or sort of more specific areas of the Indian market that look strong to you.
Yeah, man, so it's quite interesting, with the coalition government, a lot of stories that we've seen is, PSUs, you want to start rotating out of them. From a chart perspective, we've seen major breakouts within that PSU space. The index, if you look at the broader PSU index, that is, since 2008 to 2023 had been in this broad cyclical trading range. We broke out in 2023, and we still think there's still significant upside for that index of over 60%. So we think that's a space that you can still accumulate in. If you want to get more specific, PSU banks is still in that uptrend. And if you look at the relative chart of PSU banks versus the broader banks index, the re-rating that you've had from the 2020 COVID lows has only retraced half of the decade-long downtrend the PSU banks have traced out versus the private sector banks. So PSU banks, PSUs in general, we think is still a leadership space. If you're looking at the defensive sectors in fast-moving consumer goods, as well as the pharmaceutical side, interesting post the election results, we've seen pharmaceuticals break out. So that is our preference to the fast-moving consumer goods, which have just got to the top end of the range and started to roll over. So prefer pharmaceuticals over FMCG.
Lawrence, if you want to go with specific names, most welcome to. Say 3, 4, 5 top ideas, on a secular basis, which you think are, which will make a lot of money.
Unfortunately, I have to stick to the sector overviews rather than the stock specific. So if you go back to that PSU basket, I think that's still a space that you want to be accumulating in. Going forward and using the volatility that we're looking at between that 21,000 and 23,000 level on the Nifty on pullbacks to accumulate in that space. And if you want to be more defensive, obviously the pharmaceutical space we prefer. And just to remain underweight FMCG as well as IT. We've seen a bounce in IT, but if you look at that relative to the Nifty, that's fell below the 200-day, and that still maintains its relative underperformance. Maybe one more point that I'll add to the IT side. If you look at software names across the globe or a broader software sector, you've seen a significant rollover the past 6 months and a breakdown from a topping pattern. So we do see, software names globally looking quite vulnerable. And I'd put the IT service names in India, part of that basket of stocks, IT stocks globally that are in downtrends and still remaining weak.
What about crude, Lawrence? It's been well behaved from our perspective, and we've seen that there's been this melt up in metals. But for us, we are tracking crude, and we're happy to see that one still hasn't made it to that $90, $95, $100 per barrel mark. Levels you're tracking on that one?
That's right. I mean, it's very much like the dollar index been in a trading range for about 18 months, where the bottom of that range is $70 to $71, and the top of that range at 99 to 100. So we have seen, a bounce Monday session of roughly 3%, but that basically leaves oil at the midpoint of its trading range. So we're not seeing any imminent breakouts on the energy side.
Okay, and Lawrence, before we let you go, maybe an outlook on the U.S. market itself. Every day is a new high for the U.S. indices. Do you see that continuing? What about these magnificent 7 stocks?
Yeah, but it's a point that we made in our recent note that, for the first time since the October 2022 lows, the percentage of stocks above the 200-day has actually fallen, and it's down to 62%, while the Nasdaq's made new all-time highs. Now, that's not a great timing tool, but what it does suggest to us is that, the move's getting more concentrated, and that's normally a sign of maturity. So again, just singling out that software side, which has really rolled over and broken down relative to the semiconductor names, which is driven by the AR theme, remaining strong momentum trends, but it's getting far more selective, which is typically a sign of maturity. So yes, we're in an uptrend there, but you need to get more selective as this trend develops from here.
Lawrence, a savvy investor who's watching you live right now has just messaged me saying that 30,000 by 2030 is going to be underperformance.
So that's why I said I'm leaning to 37.
It's got to be
Well,
37.
it would be the smallest advance of those decades that have broken down, right? It would be 300% to 350%, whereas the 2008 to 2019 was a 450%, and obviously the 2001 to 2008, that was a 650%. So in that terms, as a trend matures, it typically does slow down. But I think 30 to 37,000 relative to some of the other emerging markets that you're looking at, you should be quite happy with that.
Fair enough. Tempering our expectations there, Lawrence. Good talking to you today. Thank you so much for joining in. Great chat as always. Okay, so the market has pretty much stabilized. Not much happening. It's very quiet at the index level. Nifty is barely 20 points higher. The bank Nifty has now cut its losses. I mean, that's one good news for the bulls. That first big gash, that's still a cut, but it's a cut now. It's not a gash. Let's just put it that way. Okay, time to move on and look at some more corporate conversations. Torrent Pharmaceuticals has entered into a non-exclusive patent licensing agreement with Takeda to commercialize a drug for gastro disorders, vonoprazan, if I got the name correctly. Well, to talk about this and, of course, the company's outlook for this year, we have Aman Mehta, whole-time director at Torrent Pharma, with us. Aman, great to have you with us on the show. Please tell me if I pronounce the drug correctly or not. And let's actually start there. What is the potential? This is a non-exclusive tie-up. So how does it work and what's the revenue potential?
Yeah, the drug is called vonoprazan. The innovator is Takeda Pharmaceuticals. So this is in the market of GERD, which is essentially acid reflux. The current market of GERD is dominated by PPIs, and that's about an 8,000 crore market. We think this is promising because this is a new treatment approved by the FDA for GERD after a very long time. There are some benefits that this provides over the existing standard of care. So it's early days to talk about the exact potential, but the market potential itself is significant in India. And that's why we feel this is an attractive new launch for us. And it is a non-exclusive patent in the sense that there could be a few other licenses that Takeda could grant as well.
Oh, fair enough. And GERD is important. It's personally important. It could be a drug that I'll watch out for as well as it comes to market. But, some sense on what has been the global size. And this would be, of course, only for India, right, that you've entered into this tie-up with? Or could you be looking at taking this drug to other markets as well in association with Takeda?
No, as of now, it's only for India, for us. The rough size, I believe, of the drug in Japan is close to $600 to $700 million. Globally, it's close to $1 billion. So it has become quite sizable.
All right. Hi, Aman. Good morning and good to see you in. This is Nigel on this side. You want to talk about business and various aspects as well. But I want to clear the air first on that inorganic growth opportunity. It was widely reported that maybe, in fact, Torrent is partnering with some PEs and could be looking at Cipla. Could you tell us, were you all interested? Are you all interested? Or is this completely out of whack and you all are not interested at all?
No, I think we can't comment on specific rumors or specific articles that come out. There have been several such rumors that have come in the press over the last several years. So would want to refrain from commenting on any specific one. But typically, we do look at M&A quite seriously as a core growth strategy. If you see over the last decade, we did decide to focus on India as a core of the M&A approach. Over the last 7 to 8 years, there have now been 3 large acquisitions that have been successfully integrated. So M&A being a core of our business model, we tend to look at as many opportunities as possible, but our appetite remains in the same scale that we've been looking at in the past, which is, say, in the range of 2,000 to 3,000 crore, 3,000 to 5,000 crore range, particularly for the India segment.
Okay, all right. So you're leaving it open-ended for now. Cipla will be a far larger, asset, if at all. So we'll have to keep an eye out for that. But you're clearly saying that you all have done inorganic growth and you all could be looking at as well without commenting specifically on this particular asset. Let's get back to business then. What was impressive in the past quarter was margins at around 32%. It's at a multi-year high, I think an 8-year high out there. Guide us in terms of the margin outlook from year on. You were hinting that there could be some improvement. What is the band we work with for FY25, FY26?
So there's two things playing out. Last couple of years, two of our export markets were facing a tough time, Germany and Brazil. Germany, we had a loss of tenders. In Brazil, the currency impact was quite negative, which in the FY24, the previous year, has corrected in a significant way. So that has helped quite a bit at the company level. As a result, what has also happened is that our share of branded markets, branded businesses in branded markets, namely India, Brazil, Philippines, Mexico, that share has now gone up to a total of 72%. So as that share increases and the share of the generic markets comes down, the margin would tend to shift up. That is where this year there has been a significant improvement. This trend, in our view, is likely to continue because we are not focusing much more on the generic markets. Our focus will remain on the branded side of the business. So focusing more on India through expansion organically, and the other markets where we've also expanded recently, like Brazil and Mexico. So if that trend continues of above market growth in these segments, then the margin expansion should also follow.
Aman, if you can talk about a little bit about the US business. Good morning, Prashant here. For FY24, the US business was down 10%. You've guided for a pickup this year in FY25. Could you tell us what are the launches which are planned for this year? Also a sense of what is the contribution of the Dahej facility to the US business?
Yeah, so we've had practically no new launches, in the last several years. So this year should be a rebound in terms of the number of launches because of the Dahej approval. Dahej has become the most important site for us now. So maybe somewhere in the range of 5 to 7 launches in Dahej is something that could give at least a bit of a revival to the US business. US has been generally a bit of a negative contributor for us, so we don't expect any major boost to the bottom line in terms of the new launches, but at least it should help us neutralize the negative contribution.
And the guidance is to get to between $250 to $300 million on the US business side in the next 3 to 5 years?
That's correct. That's something that we feel would be achievable. Generally, we've been in the 200 range, but due to price erosion and lack of new launches, it's been difficult to maintain that. But hopefully, as that trend reverses, we should be able to grow back to that level.
On this price erosion bit, Aman, so the expectation has been that, from large price erosion, it's gotten smaller, low single digits now. Then it'll kind of sort of become neutral, right? I mean, it should. Where are we at that in that process, according to you?
Our sense is that it's always a dynamic situation and changes from product to product. So at a broad level, yes, one can say that high single-digit erosion is probably what it's looking like. But it would all really depend on each product-to-product basis. Some products could be very high, some could be slightly lower, depending on what stage of competition they're in. So generally speaking, there's been a very similar trend that we've seen in price erosion. No major change in that sense.
So still high single digits broadly. I mean, if you were to put it differs product to product, but broadly it's still high single digits.
That's correct.
Okay.
Okay, all right. Well, Aman, a couple of other aspects then. You've told us for the operational performance as well. What about the debt number? The gross debt, the last recorded number that I have is around 3,900 crores. You could correct me on that number. You could tell us where is that number headed, how much lower? I'm assuming, provided you don't make any inorganic growth, because that will otherwise take this number higher.
Yeah, that's right. That's the right number. So FY24, we've repaid debt of about 1,400 crores. Net debt to EBITDA is now down to 0.87 in FY24. We believe the same trend of repayment should continue, which should bring the net debt down further below 0.5, so around, let's say, 0.4 to 0.5, and eventually become net cash positive in the absence of any acquisitions in the future.
And you have taken an enabling resolution to raise 5,000 crores, right? How will it be? Will it be a preference, QIP? What is it? And likely in this year itself?
No, hard to comment at this stage. It's something that we do as just as an enabling resolution every year. Okay. So it really depends on the situation.
Okay. Aman,
right.
We'll leave it there. Thank you very much for that. Appreciate you joining in and sort of running us through that conversation. The outlook, as you see, going forward. So very much looking for acquisitions, but not in this. I I think they said 3 to 4,000 crores range. That's essentially what they're doing, guiding for improvement in their US business. But overall, they're saying high single-digit price erosion in the US market. Those are visuals, of course, coming in. There was Mr. Piyush Goyal, and there are others as well along with him. And I think we'll have an opportunity for reporters to take questions, etc. In a bit from now. So that's the the stuff coming out of Delhi, with a lot of the political aspect of what is being tracked now coming to a bit of a close. Continuity, I think, is the large sort of message from the appointments which have taken place. We'll take a break. We are back. Umesh Chaudhary, Vice Chairman and Managing Director at Titagarh Rail Systems, will join in to talk about his expectations. I think that's the one sort of sector which has been sort of government-led, big tailwind there. So we'll be back with that conversation. Stay with us.
Welcome back. Well, the markets are a little bit quietish, but a lot of stocks in the broader markets are flying away. IMFA, that's Indian Metals and Ferroalloys. We have been telling you about this from the time the ferrochrome prices started perking up. Chrome ore has been, in short supply globally, and because of that, chrome ore prices have been moving up. And for IMFA, they're getting their chrome ore from their own backyard. Could be one of the reasons why the stock has moved up. Keep in mind, in the last 1 year or so, if I'm right, the stock is close to have doubled. But that political outcome as well, Mr. Panda's brother winning the elections in Odisha, or the BJP making its mark in Odisha in the state elections as well. So a bit of politics, the fundamental business doing well as well. And that stock has been one of the big movers. Another one that I'm looking at is BHEL. It started off more or less flattish, but BHEL now has perked up in the last few minutes. So that's moved to the high point of the day. And GMR Airports, I understand that Surbi is going to be traveling in the next week or so. And one of those airports so-called travel-related plays, stock up close to 3%, Surbi.
I'm not going to Delhi, though. I don't think I'm contributing to their numbers. But, yeah, I think any kind of travel would be good once we manage to do it. Back to the rest of the market, it's very quiet. There's not much changing on the large cap screen. The Nifty is absolutely flat. Banks remain the bit of an issue for the market. Banks and other financials as well. Shriram Finance, for instance, is cooling off after its recent run. You've got ICICI Bank and HDFC Bank. These are stocks that are still under some pressure. It is literally, some of the policy-related plays which are up and away. Texmaco Rail is up about 7%. We'll be speaking to a railway-related company in just a bit as well. But, you've got Hudco, you've got Aircon, a lot of the railway-related plays. Hudco, of course, is housing. There's Railtel, RVNL, there's BHEL. So once again, it's the same set of stocks that's moving higher. Something that our market expert Lawrence Vilanco also alluded to, expecting the PSUs to continue doing well. Let's see what's moving beyond PSUs. Again, Jupiter Wagons, similar sort of stocks on similar expectations moving higher. There's a Bikaji which continues to have a very good morning. That's about it on the screen. Shakti Pumps is up about 5%. There's HCC, which we pointed out because of the Elara note. So these are some of the smaller names that are faring well. Actually, the market breadth is still holding up quite okay. You've got almost 1,400 stocks advancing to about 800 stocks on the declining side. So that's the shape of the market so far. Right, let's move on then now and get you another corporate conversation. Domino's Pizza has crossed the 2,000 store mark in India. Their last 500 stores have come only in the last 29 months, and the company expects to add 180 stores of Domino's in the current financial year as well. To talk about this and more store openings and the business strategy going forward, Mangalam caught up with Sameer Khetarpal, MD and CEO of Jubilant Foodworks. Listen into the conversation.
Domino's has about 20,000 stores worldwide, and India is about 2,000. We are the largest single location outside of US. It's a big opportunity, right? That's how I see it. We are still scratching the surface. Who would have imagined 29 years ago we will be 2,000 stores and India will be the largest market outside of US in terms of number of stores for Domino's worldwide. I do believe the potential in India, the growth rate, rising consumption, and how Domino's have innovated for customers on value, delivery, great taste, we are going to grow. I'm very confident of it.
All right, so let's put some numbers to that confidence that you have. You know, you've always said that 10% of your revenue growth in a year should come from store expansion. The other 3-4% comes in from like-for-like growth. This year, you have a target of 180 stores to be added. That's about 9%. Should we expect a pickup in like-for-like?
Yeah, so I think it's a great point that you are making. I did qualify that in the last earnings call that we are seeing a momentum in our like-for-like growth. Feb, March, April, they're all 3 months where we've seen the acceleration. So I think that from that standpoint, I'm just reiterating that momentum continues. Backed by 4 things that we have done, we have moved from 4 regions to 7 regions to be operationally strong, led by very strong market makers who understand physical digital businesses. Second is our campaign. It happens only with pizza. We rebranded, refreshed ourselves into winning share of occasions. Third is we've focused very heavily on delivery excellence. So I think we continue to progress well on the dimension of delivery excellence. Last quarter was our best ever delivery performance in terms of speed and time. And lastly, customers have been telling us that, hey, delivery is something that they would like for free from Domino's, who's always known for renowned value. So therefore, we did free delivery during the IPL campaign. We are carrying it through to the World Cup. So very delighted to see the momentum continuing.
All right, incredible. So, you know, I just wanted 2 points then. One, you said free delivery is what you've extended. So would you at some point, look at making that delivery chargeable, because that has a direct bearing on your margins? And secondly, with this free delivery, continuing into the first quarter as well with the World Cup, all these events that we're looking at, what is the targeted LFL, at least on delivery? Because the fourth quarter, it was dragged down. The overall LFL was dragged down by dine-in. If for this year, you could give us a target of LFL in both delivery and dine-in.
Yeah. So firstly, last quarter, like-for-like growth for delivery was 7.8%.
Yes.
And for the last 3 quarters, we've seen positive like-for-like growth for delivery. And therefore, it's a worldwide trend that we are witnessing, where delivery salience is going up. Customers are going lesser inside the stores to dine in, specifically for QSRs. And therefore, we double down on delivery to add more fuel into, or more money into customer wallets to expand. So that is what is really happening over here. I think the momentum continues this quarter for sure for us. And on delivery, we also launched specifically 99 rupees offerings for dine-in customers. That has, we believe, will arrest the decline in dine-in. Again, it is about great functional experience, value. So I'm quite positive delivery like-for-like will be positive throughout the year. I'm refraining from giving up one particular number, but we continue to see the momentum, and we believe we'll be able to arrest the decline in dine-in, therefore have a much better overall like-for-like growth story.
So if you had to reiterate, roughly 10% store addition in Domino's this year with 3 to 4% LFL and some margin improvement likely this year?
Yes, I think this will. So I think the margins are, like I said, we have bottomed out. We did invest now. This quarter was also about getting the growth back, and with 50% fixed cost in our business, it flows down if the growth, same store growth comes in. And then really tightening on the cost. So teams have been very frugal and focusing meticulously on cost per delivery, rentals, electricity, LPG, everything. We are like tightening our belt.
Let's talk about the other parts of your business. DP Eurasia, 2 months consolidation. gave you about 200 crores of revenue, 26.5% sort of margins. This year will be a full year. So do we annualize it to say about 1,200 crores or anywhere between 12 to 1,500 crores?
Yes, I think we'll share more details on it. We are the first time consolidating, but yeah, it's a very profitable business. I do want to leave our viewers and investors with one. It is PAT accretive to us, and that is not going to change. And that's we knew about this business for last 3 years through board seats, and therefore had a ringside view. It's an excellent team led by the founders who built the business extremely frugally. And there's something for India to learn from there. 95% stores are franchisee owned, so less of corporate stores, very capital efficient business. And let's not forget the brand Coffee, COFFY.
Yeah.
Turkey is a country where you don't have the prevalence of pubs and bars. So coffee is a big hangout culture for the youth over there. Very high throughput per store, some of the highest that I have seen in a store. So great franchise, great set of team, very PAT accretive, asset light, and that is what we're going to see in coming quarters too.
Can't let you go without a view on Popeyes as well as Hong's. Do we see you cross that 100 crore per year revenue mark on Popeyes this year, 120 crores?
Yeah. That is, in fact, that is in the bag, I would say.
A little more than that then. Tell us what, how much more?
No, I will not give a number because I want the teams to focus on great product, great service.
Okay.
I will once we get to 100 stores, but teams are executing flawlessly on that one. I can assure that on that.
Would you this year grow faster than competition just the way you have in the fourth quarter?
I don't know about competition, but definitely will grow faster than what we have grown in the past, and I acknowledge that. But hopefully versus the competition too. Given that we have given the pace of store expansion, we are not slowing down. I do see some slowdown overall in the industry.
A bit of a yummy conversation there, but I think we'll have to continue our focus on the markets, which as we speak are not doing too badly. So all the frontline indices briefly moved into the green as we speak. But let's focus on the railways. You know, a lot of the stocks are buzzing around. This as Mr. Ashwini Vaishnav has taken charge as the railway minister in NDA 3.0. How are the hopes of continuity in the railway orders? How is the sector expected to perform from here on under a coalition government? And what is the outlook? Well, to discuss this and more, we're joined by Mr. Umesh Chaudhary, the Vice Chairman and MD at Titagarh Rail Systems. Hi, Mr. Chaudhary. Good morning and good to see you in. Continuity is something that the stock market wanted. And I'm sure as a participant in the industry, you as well will be quite happy to see continuity in terms of the ministry. Could you tell us how does this change things? The only worry that the stock market has is now it's a coalition government, so maybe the decisions don't come about. Your quick comment on that and then we get straight to business.
Sure. Good morning. Thank you for having me with you. And it's not only the stock market that wanted continuity, much more than the stock market, the industry wanted continuity. Particularly, you know, I mean, if you look at the growth that the railway sector has seen under the current railway minister, and then overall in the last 10 years under the Modi 2 regime, it was very important that this momentum that has picked up in the railways continues. And with the current railway minister, Mr. Vaishnav, continuing to be the minister, industry is extremely buoyant and very happy that this momentum is likely to not only continue but to accelerate.
Okay, all right, got that. So give us then a couple of numbers. What is your current order book? If you could tell us as on date, what is it? And what are the kind of order inflows you're factoring in for this year? A rough number. And if you could give us a comparative number as well, what were the order inflows in the past year?
Sure. So, I would not be able to give you the current order book, but what we had declared with our last results in the March results, that our total order book was about 28,000 crores, in which half of it was our share of the joint ventures of the SPVs that we have got the tenders in. And the balance is split between the passenger and the rail and the freight side.
Okay, all right. And
the fresh orders that we are expecting, yes. I believe that there is going to be a big spurt of the passenger trains. Wagon, of course, is already there. The freight wagon business the railways already, we know the targets that are there. The freight targets are very, very buoyant. But also in terms of the passenger trains, we have seen the railway minister in the past announce that we will be entering into the era of waitlist free travel and so on. So that obviously means that a lot of new Vande Bharats will come up. I would only say that we are creating capacity which is quite substantial. I've disclosed in the past that we are setting up capacity to be able to produce almost 850 passenger coaches a year between Metro and Vande Bharat, and we believe that the demand that is likely to come up is going to take up that capacity.
Mr. Chaudhary, and you'd said that you were expecting a large number of tenders on the passenger side, both from metros and Vande Bharat, right? So a lot of them in the pipeline. I think last when we spoke in May, you said that this is the Railway Ministry figure, 3,500 Vande Bharats to be added in the next 5 to 7 years. So yeah, the opportunity is there. Now, just a quick point, a detour actually, Mr. Chaudhary, Prashant here. There have been news articles, there have been a fair bit of chatter on social media, etc., about how maybe in railways you need maybe more capacity at the lower end, not just the Vande Bharats. There are two issues. One, of course, is price, affordability for Vande Bharats, which is at a premium, and of course, second, at the lower end, you need more capacity, overcrowding in trains, etc., etc. Because this is the third term, and Nigel started by asking, and you mentioned policy continuity with Mr. Vaishnav, but do you see any slight sort of change in direction? Maybe a little less focus on the Vande Bharat, maybe, but a little bit more on the other regular trains. I mean, just your thoughts on this debate.
In between, but whatever I could make out of the question, I'll try to answer that. If we look at the railways, what they have done is they have come up with different versions of Vande Bharat. So there is a Vande Sadharan, there is a Vande Bharat, there is a Vande Bharat sleeper that we are doing. There is a Vande Bharat chair car which is already running. So the Vande Metro is been announced. So number of variants of the Vande category. So let's not look at Vande Bharat as one type of train. This is one class of train. What does that class signify? It is a class that signifies better comfort, better safety, a higher quality train travel in general. And then it is being catered into, it's almost like the airlines. There are budget airlines, there are premium airlines, there are business classes and first classes in international travel. So my personal understanding is that the railways is moving towards that. And there are different options that will be offered for the different audience or different clientele, if I may say so.
But within these, right, as you said, I mean, there are different categories in that sense, but could the focus shift a little bit from the premium Vandes to the lower end Vande Bharats? I don't know if that's the right way to ask you. I mean, do you expect a more focus there? And does that mean anything for your business? Yeah.
So yeah, I was about to say that as far as we are concerned, we are making trains. So we can make trains of different categories, of different classes. And depending upon what kind of trains are required by the market, the amenities which will be fitted into the train or the facilities that will be provided within that train will be adjusted accordingly. But having said that, on a larger scale, I believe, this is my personal view, that while the trains to cater to the masses will of course be in the future, and there will be a focus towards that, I don't think that will be at the cost of putting in trains that are also catering to the higher end of the spectrum. I always believe that the train that is being done by the railways, where we have been fortunate to be a party to this, which is the Vande Bharat sleeper version, will give a stiff competition to the airline and the hotel, because it will be basically a hotel room on wheels for a particular class of travelers. So I believe that the trains that will be there required or will be there in the Indian railway system will be catering to the different strata of the society, different requirements of the society. And in either which ways, our capacity is fully fungible, whether it is a ordinary non-air conditioned train or an air conditioned train. We would be able to cater to that to all these segments equally with equal comfort.
Sure, sure. Mr. Chaudhary, you've guided for improving margins. I think FY25, the outlook you've given is about 10%, and gradually it could go up to 13 to 15% over FY26. Is that going to be a function of the fact that your passenger business will scale up? I mean, typically, what's the variation in margin between freight and passenger? And within passenger, if you could tell us, there's one day, and then there is a lot of the metro work that you're doing as well. So what will be the profile of your passenger book?
Sure. So as far as, again, when I spoke about fungibility on our capacity is also fungible between Vande and Metro. So basically, we will have a capacity to produce 850 coaches a year in what we are installing currently, which will be fungible between Metro and Vande Bharat. Right now, the planned capacity is half and half. Our capacity utilization is half and half. In terms of the margin profile for the passenger, and I speak about the passenger alone right now, as I had mentioned, that once we are able to reach a certain volume, right now we are in the very nascent stage of the business. Last year we did hardly about 3 to 4 coaches on an average per month. This year we should be able to increase that to about close to 15 coaches, and then thereafter 2026 will be the real jump, because the Vande Bharat production will also start. So the margin will move to about 10, 11% with both the segments without propulsion being manufactured by us. And we believe
Sure.
by FY26 and 27, we would be able to make all the propulsion or most of the propulsion required in-house, which will then improve
Sure.
our margin to about 15%.
Okay, just one last number, sir, before we let you go. What's the capex outlay for this year? How much are you spending this year?
So between last year and this year, we'll be spending about 1,000 crores, and that is already on stream.
Okay. All right, Mr. Chaudhary, we'll leave it on that note for today. Good luck with those plans. And now there's clarity. There is policy continuity in your segment. So I guess you and the markets will hope for the best. Well, with that, let's come back to the market. And we've got Mitesh back in. The dip has been bought, as is usually the case with this market. Mitesh, so what do you make of it? That's an interesting looking chart.
So actually, it's become slightly easy. You get a dip, identify a good support pivot, and try to buy it around that. I think even on an intraday basis, is working well. So the idea is to remain trade on the long side, and on the stock side, I have Bajaj Finance, which had a pullback yesterday, but the structure is very positive. So keep today's low as the stop loss 70.50, and look for a target of around 7,300 to begin with. And if that is crossed, the stock might go even higher. So quite a positive chart there. And the second stock, which I like, and I've been recommending FMCG also for the last few days. So Britannia once again has come on the radar. That's a buy with a stop just below levels of 55.40 and a target of 56.60 can be.
Okay, all right, Mitesh, we'll leave it there. Thank you very much. Those are sort of newer trades coming in from Mitesh at this point. Look at HCC. I think there is a Elara note which is projecting a big upside for this one. Old player in the construction space, but it's coming back. New lease alive, 45 rupees right now on HCC on very large volumes as well. We'll take a break. We're back. We put the focus on commodities. Manisha comes in for that. Stay tuned.
Welcome back. So we've looked at the equity screen, which has managed to come back in the green. Let's find out what's happening in commodities. We've got Manisha back with us. She's in the studios now. Manisha, so what do you have your eye on?
Well, I'm looking at the sugar prices, and internationally, we've seen sugar prices being really, really volatile. It's been trading at multi-month lows and then multi-year highs in the last 1 year. So if you look at 2023, we were trading at 28 cents a pound, and then the prices dropped all the way down to 18 cents by May 2024. We're trading at 18.6 right now, and the markets do believe that this is perhaps the area where the sugar prices seem to have made a bottom right now. The speculative activity that took the prices all that way, and then in sense of all the at these current prices, perhaps seems to have been done right now. If you look at the international markets, well, the latest ISO report suggests that there is a deficit that they're looking at into the markets. So if last year deficit was at 1.12 million tons, this year is anticipated at 2.95 million ton. One of the reasons that you could be looking at support in the markets. Now, when you look at this year, this expectation is that we are looking at a record production and a record consumption in the global markets as well. So those are those numbers there. But the more important number is about the closing stock or the ending stock, which has declined by 53%. And this perhaps could be one of the reasons that the global sugar prices could be looking at some support going forward from here. Well, the markets are anticipating that with the kind of demand that we're looking at in the international markets could be supportive. This is the global sugar numbers, as I said. We're looking at record numbers in both of these senses there. Talk about the Indian markets then, and we have seen consumption here as well continue to grow. So if last year was at around 227.85 million tons, 29 million tons in 23-24 has been an all-time high, and an expectation that you could only be looking at higher numbers going forward. The market participants also tell me that these numbers also are inclusive of some smuggling that happens in the neighboring countries, and that is the reason sugar consumption within India shows higher. But nevertheless, we are looking at that number continuing to increase there. Now, important stuff really going forward is, as the new government has been formed, sugar as an industry in the next 100 days in sense of agenda also hopes that India could be looking at increase in MSP1, and second, a long-term ethanol policy is something that Indians believe that could be seen as we look at reforms and policies.
All right, Manisha, thanks very much for that. So that is essentially commodities in focus. Well, HCC is the stock I was talking about before we sort of took that break. Stock's flying, but Hormuz is here to tell us why. Hormuz.
Absolutely, and it's flying also up almost 14% now as we speak, and that is because Elara has initiated coverage on the stock. It's the first coverage that the stock has had in quite a while now, after all the debt resolution and all of that happened with it. It's initiated coverage with a buy recommendation. Its price target is 63 rupees, which compared to yesterday's close is a potential upside of nearly 60% on the stock. Now, what Elara says is that HCC is poised to reclaim its lost glory after almost a decade-long effort, which has led to an improvement in its financial performance. Now, what they also say is that HCC is well placed to capitalize on this 1.5 lakh crore nuclear opportunity in the country, and that is because they have decades-old experience in executing in-house and complex marquee projects. They have a 26% share of the country's hydropower capacity and a 60% share in India's civil nuclear power capacity. So all of these factors bode well for the company to capitalize on this 1.5 lakh crore nuclear opportunity. What they also say is that now HCC can also bid for new contracts after the recent credit rating upgrades. The ICRA had upgraded its credit rating in December. CARE had also upgraded it at the start of the new year as well. So that was a positive, and they can now also bid for it because the restrictions on their bank guarantee limits have been removed. So both these factors will lead to HCC enabling them to bid for new projects as well. So what Elara expects a standalone revenue and EBITDA CAGR of 20% between FY24 to 27 and an earnings CAGR of 50% during the same time frame because of the lower interest costs. So a positive initiation there from Elara on HCC, the stock up and about in today's session.
All right. Thank you very much, Hormuz. That was a great heads up, by the way, just before the market opened. That stock opened immediately about 7% higher, now clocking a 13% gain on the back of that Elara note. Vivek is with us. Vivek, all the blocks have happened on IndiGo, IRB, Hunasa. Run us through the numbers.
Well, you're right. We told you, earlier today and also late last night about how there were expected to be almost 3 large block deals. All of them have fructified, at the open itself. So the first one that we were tracking today is IndiGo. It's the promoter entity, which is Interglobe Enterprises today, which has sold. Now they've sold close to 2% of the total equity, worth almost 3,290 crore worth of shares. Remember, they continue to hold even after today's block deal over 35% stake in the company. Now the second stock on the radar is IRB. entire be infra. Surprisingly, remember, just 2 weeks ago, had the promoter entity selling. Today, another large private equity investor, which is Sintra, which is an associate of Italian company Ferrovial, sold almost 5% stake in today's trading session. They held close to 25% stake at the end of Q4, so they will continue to have around 20% stake after today's block deal as well. There is a lockup of 150 days on further sale of shares, after today's block deal. Now, the deal, when you're talking about what was the total size of the deal, almost 1,900 crore is what changed hands. And lastly, Honasa Consumer, again, 2% of equities changed hands. Two strategic investors, one Fireside Ventures, that had 5.2% stake, and Sofina Ventures that had 6.1% stake. Both of them appear to have paid 1% stake in today's block deal. Total size of the block was over 270 crore.
All right, Vivek, thank you very much for that. Those are visuals of Manohar Lal Khattar, former Haryana Chief Minister Manohar Lal Khattar, who's essentially taking charge as the Power and Housing and Urban Affairs Minister. Visuals coming in right now of him being felicitated and cameras. I'm not sure if there's going to be a soundbite. We've heard from other ministers who've taken charge, starting from, of course, Dr. Jaishankar in the morning, External Affairs. We, I think, are also getting in sort of sound bites from, the Minister of State for Civil Aviation, or Minister of State for Oil and Gas, Suresh Gopi, the Malayalam film actor. I think there were sound bites coming in there. So through the course of the day, we will hear more from some of these newly appointed ministers. People are taking charge. Markets, by the way, come up very, very nicely. 60-odd points higher. We're at about, 23,300 plus at the day's highest point. So not a bad look at all told. Well, we'll take a quick commercial break here. On the other side, my colleague Lata will connect with Nilesh Shah, MD and CEO, Envision Capital, and they discuss the NDA 3.0 portfolio distribution and what kind of impact it can have for markets and stock selection. Stay tuned.
Forgot. Welcome to our special Market Masters today. The list of ministers is out, and if you were a Rip Van Winkle who slept through the election and the results, you will think it is actually the same government in power, just cut-paste. So, how should stock traders and investors read the continuity in the Council of Ministers? What sectors should one bet on, expecting policy, of course? And what does the signing of the Kisan Samman Nidhi and PM Awas Yojana as the first two programs of the government signify? Again, what about ministries given and not given to the allies? For these and all questions, I'm joined by Nilesh Shah, the promoter of Envision Capital. Nilesh, thank you very much for spending time for us. Well, first up, cut-paste Council of Ministers list, at least as far as the key offices are concerned. Do you think this will trigger rally? I mean, already the market has bought the dips. Do you expect things to pick up from here on?
Yes, I probably think so. I mean, if we look at essentially the list of ministers, one thing is for sure that there is going to be continuity. That's essentially the underlying trend, underlying theme. That we are going to see essentially continuity of what we have seen for the previous 5 years or maybe over the last 10 years. And what this implies is a continued focus on economic growth with essentially a tinge of fiscal consolidation. So you're going to see a continued period of macroeconomic stability. And this is what markets want. This is what investors will be looking forward to. So to that extent, I clearly believe that the next 5 years from an economy point of view and from an overall business environment point of view, it will essentially be the continuation of the policies and the focus on growth that we have seen over the last many years.
Okay. Railways, actually, Ashwini has got a lot of portfolios. You know, he's got Railways, Meiti and INB. What do you read from this? Do you think the railway stocks are worth betting on? Do you think it will not be all that populist as was expected? You know, the big expectation was railways will go to maybe JDU, maybe Nitish Kumar's party. What do you make of this particular sector?
Well, it continued to kind of show interest in the railway space. Clearly, that's been a top priority of the government over the last 3 to 4 years, especially in the post-COVID era. We've clearly seen a huge focus on railways, and that's really, many years back, it was clearly the roads, which was essentially the very big focus of the previous governments or the previous tenure of this government. But clearly over the last 3 to 4 years, it's railways which has essentially become the center of focus. And clearly lots has happened, many new initiatives, huge progress, huge development there. There's a huge thrust on introducing new trains, faster trains. There's a massive overhaul. The stations are getting modernized. So I clearly believe it's been so far a period of expansion, innovation and modernization as far as Indian Railways is concerned. And I think it's very heartening to know that we still continue to have Mr. Vashni as the Minister for Railways. And that I think augurs really well for the rail sector as a whole. Coming down to individual investment opportunities, of course, as investors, we will obviously have to be focused on the kind of multiples that we pay for these stocks. But I still believe overall, the tailwinds for the sector continue unabated.
Okay. The only other specific sector, roads, again, there was an expectation that the allies will stake their claim. But the expert has returned back in roads, Nitin Gadkari. Does that mean anything in terms of road construction, capex, cement stocks? I don't know. How would you approach as a stock investor?
We've probably got the best man for the position, the most experienced. I would probably call him the veteran of the space. So to that extent, again, that continues to be an excellent choice. And the fact that the Prime Minister has chosen to kind of maintain continuity, again, bodes well for roads as a sector. And therefore, it means continued expansion of the road network. It means more demand for construction services, more demand for construction equipment, more demand for construction materials. So I clearly believe that the overall sector is very favorably poised for a period of extended and a continued growth for a few more years. So to that extent, again, a great decision, and I think that means we'll continue to see better prospects for the sector. And on the whole, Lata, if we were to kind of combine both railways and roads, clearly I think what it signals is a continued priority for infrastructure growth, infrastructure building, and ensuring that India has world-class infrastructure to support our manufacturing and our other businesses and to make India way more competitive as a manufacturing business and investment destination.
Yes, that's true. You know, when have we last had 3.3% of GDP as investment in capex? Revex has always been a giant absorber of government revenues. Do you think that gets affected? I'm asking you only because the first two files signed were Kisan Samman Nidhi and PM Awas Yojana. To be fair, both are existing programs, and money had to be dispersed for 2 months nobody had signed anything. Maybe it was just that, but isn't it symbolic? And therefore, do you expect, more welfare and perhaps something taken out of capex?
I expect the welfare programs to continue because
not increase.
No, there can be an increase, and that would essentially be a function of economic growth and tax collections. I think both of these essentially will define the denominator, and essentially the denominator becomes the base. And if the denominator and the base keeps expanding, you would see increased outlays also going into welfare. But I still believe that as a percentage, it will continue to be way more measured. The way it has been in the past, that despite very, very difficult situations, I think that piece got managed really well in terms of the allocations and especially as a percentage of GDP, which ultimately has resulted into a declining fiscal deficit. So to that extent, we must give it and we must concede it to the government, to this government, that they have been way more balanced in terms of the fiscal responsibilities. And I believe that that mantra or that priority will continue for the rest of the tenure.
Okay. So no danger to capex or deficit?
No, I don't think so. I still think that both will continue to be the two pillars of the government spending. And I think the government is extremely cognizant of that, and it has already shown it in terms of its past actions. So to that extent, I would again think that even on these fronts, be it allocation to infrastructure or be it allocation to welfare programs, I would still think that the government will continue to demonstrate equanimity rather than just going overboard in either directions.
Okay, let me not ask you individual ministries. I've probably asked them all. What's your overall take after looking at the ministries and looking at stock valuations? What would your priority list be in terms of attractive sectors?
So, Lata, again, I think if you look at the composition, the list and the composition of the cabinet, I think, again, it just showed continuity, so as to say. And clearly
what I meant was specific defense, private sector, public sector companies, railways. In all this, as you correctly pointed out, the valuations have become crazy. So where do you still see value?
So the great part, Lata, is that these are opportunities which are very huge in terms of the number of companies, be it defense, be it energy, clean energy, be it manufacturing, be it indigenization, be it infrastructure built up. I think all of these essentially are still very, very long-term opportunities. Still, we have a long way to go. So to that extent, the businesses will keep growing. And I think in each of these spaces, there are a whole range of maybe, several dozen companies out there. And within that, I think we have to kind of keep selecting individual companies, not that we necessarily put all our capital into necessarily just these opportunities. But yes, we will need to participate and look out for those individual companies where valuations still are reasonable in context of the growth ahead. So we have seen that as long as companies continue to grow, valuations are less of a challenge. I think valuations become a challenge only and only when growth begins to plateau and taper off. I don't see any signs of growth tapering or plateauing as yet. Still, I think these companies will continue to grow for maybe at least next 1 to 2 years. And still there are pockets of where valuations are way more reasonable in context of the growth that lies ahead for the next 1 to 2 years. Of course, we have to keep in mind that these are not sectors of businesses on which sitting today we can take a 5 or a 10-year view. These are companies which essentially, of course, depend a lot on the government spending, and they will essentially, therefore, the growth is going to be maybe there for the next 1 to 2 years. I mean, the period of hyper growth, which I may call, will be there for a couple of years. But it's hard to take a call today whether this growth will continue for the next 5 or 10 years, because at some point of time, when you've already made investments in these sectors, beyond that, then growth will normalize for these sectors. So one will have to be, cognizant of that.
Okay, fair point. The curve will plateau at some point. Considering that the allies have not asked or perhaps got any plum portfolios other than civil aviation for TDP, do you think that some Andhra package or Bihar package is in the works? And again, as an investor, how will you look at it? Is it, Amravati building and therefore cement stocks, Andhra companies? I don't know. As an investor, tell us.
So, Lata, both these states, of course, have been having their own set of demands, which have been there for now a very, very long period of time. And I probably think that the leaders of these political parties and of these states have probably already voiced or reiterated, that obviously their respective states will need a fair share of the development as well as the allocation. So to that extent, and these are two very large states. These are not, small states, tiny states that they won't move the needle. Both Andhra and Bihar are big states, massive states. And to that extent, whatever increased allocations that both Andhra and Bihar receive will actually have an impact on India's aggregate GDP. So to that extent, if there is allocation, and keep in mind that both these leaders also have a strong track record of development and capital allocation. And to some extent, they do have a track record of being reformist. So to that extent, it's actually great that both these two states will probably get higher priority than what they have got in the past. And that would mean increased allocation, increased spending. And so to that extent, especially from an Andhra Pradesh point of view, you're going to see increased investments and step up in infrastructure. The fact that a new capital is likely to be built will going to entail, investment of thousands of crores, and that bodes extremely well for construction companies, especially the local regional companies. So construction companies, construction material companies, construction equipment companies will again get an added layer of growth for themselves for a long period of time. Coming over to Bihar, apart from infrastructure, I think Bihar, of course, has been witnessing some strong consumption as well. And therefore, a lot of local regional businesses, which are more consumer-oriented, retail-oriented, will also benefit, apart from, of course, the infrastructure companies. So I clearly believe that these two states will contribute meaningfully to overall India's economic and GDP growth over the next 5 years or so.
Okay, our viewers will want some very pointed advice from you, Nilesh. So a very quick last one, your hierarchy of sectors and returns from the market this year and next.
So, Lata, I think, from a very long-term point of view, consumer and financial still should be the mainstay and receive a fair share of the allocation. These are long-term compounding opportunities. Other than that, I think businesses which are a play on clean energy, businesses which are a play on the mobility transition and the renewables, electric vehicles, I think all of that entire pack with a dose of manufacturing-oriented businesses, energy-driven businesses. I think these are some of the sectors which I think should do well from a medium-term perspective, which means from the next 1 to 2 years perspective. As I said earlier, hard to take those 5-year, 10-year calls on these sectors. So I think it will have to be consumer and financials as more long-term plays, and then of course the whole defense, railways, infrastructure, energy as more the medium-term plays. Lata, in terms of what investors can expect, I believe the economy will continue to demonstrate a 7% GDP growth, maybe a 10 to 11% of nominal growth, which means corporate earnings will grow at about 12 to 15%. My view is that I think 12 to 15% in line with the nominal GDP growth and earnings growth is what investors can expect from the Indian equity markets over a 1 to 2 year perspective. Of course, in the process, if interest rates falls, markets get higher valuations, the FIs come in even a bigger way, then that can be the icing on the cake or the cherry on the cake.
Fair point, fair point. That's very helpful numbers. Thank you very much, Nilesh, for packing in so much in such a short time. Pleasure having you with us, as always.
Thank you so much.
Okay, so the markets, after that initial dip, have greeted the Council of Ministers with a lot of green on the screen, in particular the mid-caps up 7%, up 0.7%. Wrap up on Bazaar on that note, Chartbusters out.